All right, let's jump right into it. You've probably seen the headlines. Mortgage profits are plunging. But what's really going on behind those big, scary numbers? Well, that's what we're here to break down.
So, let's set the scene with just one number. Picture this. It's the third quarter of 2025. Independent mortgage banks, they're doing pretty well. We're talking a profit of over $1,200 for every single loan they close. Not bad, right?
Okay, but now hold on. Let's fast forward just 3 little months to the end of the year. That $1,200? Poof, it's down to just $674. I mean, we're talking about their profit getting chopped almost perfectly in half.
Yep, you're seeing that right. A 44% drop in a single quarter. That is a massive hit. But here's the kicker. The reason for this freefall? It's almost certainly not what you think it is.
Okay, let's get into it. First up, what we're calling the headline shock. You know, that big, flashy number that caught everybody's eye, that 44% decline. So the Mortgage Bankers Association put out this report, and the main takeaway, the thing everyone's talking about, is this huge profit dip for what they call IMBs, independent mortgage banks. You know, these are the lenders that aren't your typical big bank, they just do home loans. And a shift this big? Yeah, we definitely need to dig in a little deeper.
Naturally, when you see a profit number just collapse like that, you assume their costs must have skyrocketed, right? Like they must be spending way more money to make these loans. But nope, that's not the story here at all.
And this is where things get really interesting. See, this wasn't a cost problem, it was a revenue problem. The amount they spent to get a loan across the finish line, it stayed almost exactly the same. But the amount of money they brought in from that loan, that's what took the hit.
Okay, so the big question is why? Why did revenue suddenly drop off a cliff? Well, the answer is a little bit in the weeds, but it boils down to two super important, kind of technical things you got to understand about the mortgage biz.
The first one is pretty straightforward. It's basically just a quirk of accounting. They had a big rush of business right at the end of September, and all that money got booked in Q3, not Q4, so made Q3 look amazing. The second reason, though, has to do with something called MSRs, and that one's a little more complicated.
All right, let's break down MSRs real quick. Think of it this way. When you get a mortgage, someone has to collect your payment every month, right? That job, the right to collect the payments, is an asset. Lenders can buy and sell it, and just like any other asset, its value can change depending on the market. In Q4, the value of these servicing rights went down, and that took a bite right out of their profits.
Okay, so we've been deep in the details. Let's pull back for a second and look at the bigger picture of the industry's overall health, because that scary 44% number, it's dramatic for sure, but it is not the whole story. And this right here is why context is everything. Look, yeah, profits were way down compared to Q3, but, and this is a big but, they were actually up compared to the same quarter the year before. A year ago, these companies were actually losing money on loans. So while Q4 wasn't as great as Q3, it was a heck of a lot better than where they were a year prior.
And get this, even with those tighter margins, most of these companies were still making money. We're talking more than 2/3 of them were still in the black. So things weren't nearly as dire as that one headline number might make you think.
And on top of that, business was actually picking up. Lenders were closing more loans, and those loans were for bigger amounts. The volume was there, the activity was there. It just wasn't turning into as much profit per loan. But, and this is the elephant in the room, it is still crazy expensive to originate a mortgage right now. Over $11,000 a pop. That's way, way higher than the historical average, and it puts this constant heavy pressure on their bottom line.
Okay, so we're talking about lender profits and MSRs and all this industry stuff. But why should you care? Well, whether you're thinking about buying a house someday or you just like to keep an eye on the economy, this stuff actually connects directly to you. Here's why it matters. These independent lenders, they're not some small corner of the market. They are the engine of the home buying market. Think about that. They handle almost 3/4 of all purchase loans. For a huge number of home buyers, these companies are the market. So, at the end of the day, their financial health isn't just a number on a spreadsheet. It has a real impact on Main Street. When the profits get squeezed this tight, it can eventually affect how much a mortgage costs and how easy it is to get one. Their well-being is, really, a pretty good barometer for the entire housing market.
And all of this leaves us with one big, forward-looking question. You have these costs to make a loan that are just stubbornly high. And you've got revenue under all this pressure, so what's the path forward? What does it actually take for the industry to find its way back to stronger, more stable profits? That's really the big question everyone's going to be watching.